Well, let's get some reaction as the European markets rally. Joining me from the offices of Lloyds at TSB in London is the bank's head of market strategy, Diebel. Thank you very much indeed for joining us today. What was quite interesting last week amid all the mayhem was when that rally started, it wasn't equal. Normally the DAX, the CAC, the FTSE react broadly in the same way, and yet the FTSE did appear stronger. Is there a sense in which the UK could be viewed as a safe haven?
Yeah, I think that's exactly right. I think you're in a situation here where the relative credits and the outlook for that relative credit is all important. That's, if anything, what you've really learned from the S&P downgrade of the US to AA+. And that leaves us with a situation where both France and Germany are part of the Eurozone, obviously, and thereby involved in the whole process of finding a solution to the Eurozone's sovereign crisis, whereas the UK is on the outside. It's not subject to that, and likewise has a floating currency, which, if nothing else, gives it one additional policy tool that the others don't have.
And so do you see this as something that we're going to see more of going forward until the crisis in the Eurozone is resolved some way?
Yeah, definitely. I think that's the case. I mean, clearly, there's a lot of short-term focus, for example, on the meeting between Chancellor Merkel and French President Sarkozy tomorrow. Will we see anything particularly dramatic? I'm not so sure. Virtually every meeting it comes under a great deal of scrutiny at the moment, just as the market is scrabbling around for some kind of resolution. But unfortunately, I think you're talking weeks, not days.
Now that we've had a little chance to kind of look at this US downgrade in some kind of perspective, obviously we didn't see a reaction in the US Treasuries. The money didn't come straight out of those. What effect is it going to have in the medium term, this downgrade?
I think that's a very good question. You know, the short-term reaction was just dominated by risk-off, and the sell-off in the equity market generated a very sharp spike in US bond yield, sharp drop in US bond yields. But I think longer term, the question really is about diversification away from the dollar and away from dollar assets, and particularly if we wind the clock, say, forward 5 years, and for example, we have a stable Eurozone and you have a fully convertible Chinese yuan, then you effectively have a multi-pillared world, and that's, you know, going to lead to probably greater volatility and certainly greater price swings, and people will have a real choice where their base currency is, whereas at the moment everything is dollar orientated, and I think that's the big seismic shift that's coming over the next few years.
So do you think that we're going to see a move away from the single reserve currency, and does that mean did that start on the day of the US downgrade? Do you think that's a step too far to say that?
I think it's a step too far to say that was the catalyst. I think it's a process that's been underway for a number of years. Certainly, if you look at the behaviour of the Asian reserve managers, for example, they've been busily trying to diversify away from dollar assets for a number of years. But you know, it's a slow process, and that doesn't actually involve them selling dollar holdings. That's more about where do they invest their new reserves, their recently generated reserves, and that is clearly finding a home away from the dollar. It was the euro, but they're also looking at currencies like the Aussie and even some of the Scandies now.
What does that do to US Treasury bonds?
Well, in the longer term, the downgrade, particularly if it's ever followed by any of the other ratings agencies, it's going to raise the cost of credit. And, you know, we still have a number of hurdles to face in the US, particularly with the committee being formed about how to implement the budget cuts that were agreed as part of the debt ceiling. You know, if there is no progress in the short term and they can't agree, then we get an automatic situation for next year, which is going to be really bad for growth. So although the macro story in the next 6 to 12 months could be still quite positive for US Treasuries, the longer term, you know, the weakness of the credit rating and the fact that the debt level is still going up quite sharply over the medium term, and particularly with all these contingent liabilities, then you have to be talking about, you know, a higher prevailing fair value for US Treasuries in terms of the yield level.
Very interesting stuff. Thank you so much for joining us.